Hello, everybody, and welcome. This is my solution walkthrough, and this is for Wiley 8th edition accounting tools for business decision making. This is problem 13.5. The authors are Paul Kimmel, Jerry Weingant, and Jill Mitchell. The question used in the presentation is copyright 2023 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2023 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of myself and not the authors of the textbook or of Wiley. So let's go ahead and get to it before we say thank you to Wiley. So our question here today is actually a little bit of a good one. The problems I have with this question, and this is Wiley, if it were me, I would never use future numbers for a company. And it's just something that it's kind of like a pet peeve of mine. But using 2025, you're better off using historical data. The other thing I'm going to show you over here is that why these numbers are totally phony is because, like, what do Target and Walmart do? They sell stuff. And when we look at the balance sheet of Walmart, right, what's their biggest thing? Well, they sell things. So their biggest thing over here is really going to be their inventory. Their inventory as of October 31st, 2022 is about 64.7 billion, right? Their AR is insignificant. And then if I go over here and look at Target, right, if I come over here and look at Target's assets, cash, inventory, other current assets. Do we see any accounts receivables? Well, if I come over here and I look at what they're showing, average net AR of 7.5 billion. I mean, it's no way. So again, if you're looking at these companies, for example, and this is the real better question. If I'm looking at Walmart and I have a choice between AR turnover and inventory, which one do I choose? Well, inventory is roughly about 25% of Walmart's total balance sheet. So you would want to use inventory turnover because it's such a huge percentage as a percentage of total assets, a huge number. So this is really, again, when you're looking at, how do you go through and analyze companies, you're choosing ratios that are going to be relevant to what you're trying to analyze, not everything. So with that all being said, let's go through and take a look at this problem. So right over here, basically I've gone through and have taken the liberty of going through and putting out the ratios for us. If you're taking my class, what's going to happen is when you come into the exam, I'm not going to have you memorize any ratios. Like, that's just moronic. Okay, you don't need to memorize ratios. They're going to be given to you. The question becomes is how do I compute them? And then more importantly is what do they mean? Okay, so current ratio over here for Walmart, right, or for Target, right? So my current ratio is going to be my current assets. So this is going to be 18,424 divided by my current liabilities. My current liabilities are 11,327. So for Target, the current ratio is going to be 1.62. For Walmart, this is going to be my current assets of 48,331 divided by my current liabilities of 55,361. So over here, you take 48,331 divided by 55,361. Good job, Bennett. Current assets divided by my current liabilities, and this is 0.87. From a current liability standpoint, you might say the Target's a little bit better, but it's not. Okay, this is just has a better ability to go through and pay off their debt. But I can tell you right now, these numbers are made out of fantasy land, and it's just the numbers that Wiley's using for this particular item. From a ratio perspective, though, for the current ratio, I want this to be as high as possible, and just because it tells your ability to pay off your current liabilities. If I was looking at these companies, though, and if I was really to choose a better ratio, it would be the quick ratio or the acid test ratio, because you're taking very current assets, cash, current receivables, marketable securities, and you're dividing that by total liabilities. And with both these companies having heavy inventory, that's probably the better one to go through and do. Okay. AR turnover, right? Sales on credit. And let's see what the question said over here. For each company, compute, assuming all sales were on credit. Okay, which we know is not the truth, but we'll go ahead and oblige them. Okay, so AR turnover is going to be for target. It's going to be 65,357. And this is going to be divided by my average accounts receivable. Over here, it gives us average net AR is 7525. So over here, this is going to be 65,357 divided by 7525 or 8.68. For Walmart, this is going to be 408,214 divided by 4025. So this is going to be a total of 101. Okay, so what does this mean over here? So my AR is turning over 8 times per year, whereas at Walmart it's 101. Now this ratio is meaningless to these companies because they don't have a significant amount of AR outstanding. The average collection period, I'm going to take 365 divided by what I just computed above. So what does this mean? It's taking me 40 days to convert accounts receivable into cash. Over here, this is basically taking, the 3.59 days to convert it. And it doesn't make sense. And again, it's because these companies deal with a lot of cash. Inventory turnover. Okay, so this is going to be my cost of goods sold, which is going to be 45,583 for target. And I'm going to divide this by my average inventory of 9642 or 6942. So my average turnover, inventory turnover for Target is 6.56 per times per year. Over here for Walmart, this is going to be 304,657 divided by my average inventory of 33,836. And so this number over here is going to be at 9. Okay, meaning it's turning 9 times per year. So if I take 365 and divide it by 6.56, this is going to give us my activity or my days sales. What is this one? Days in inventory, right? So this is going to be 365 divided by 9. So we're taking 365 divided by here. So this means that my inventory is basically, it's taking me 55 days to convert. Here it's taking me 40 days to convert. Profitability. Okay, so this is going to be my net margin. What is my profitability going to be? This is going to be 2488, which is for Target, divided by my total sales of 65,357. Over here, this is going to be 14,335 divided by 408,214. So again, my net margin or my profitability margin right over here is going to be 3% for Target. And it's probably going to be even less for Walmart or right around the same amount. Okay. Again, is this a normal thing? Well, Target is slightly more profitable, but if you look at just the volume of sales they're pushing through, Walmart has them beat hands down. Over here, total asset turnover. And what I'm going through over here and doing is it's just asking me to kind of go through and to do these different ones. So we just did profit margin. Now we're on asset turnover. So for asset turnover, we've got over here, we've got net sales, and this is going to be divided by average total assets. Okay, so my net sales over here are going to be 65,357, and this is going to be divided by my average total assets. My average total assets are going to be For target, it's going to be my beginning of year balances. So this is going to be 44,106 plus 44,533. This is going to be my average total assets. So I'm going to take 44, divide this by 2. Over here, this is going to be my average total assets for Walmart is going to be 170,706 plus 163,429. So they're giving us the beginning of year balances right over here. And so that's what I'm kind of going through and doing. So the average total assets, right, are going to be 44,106 plus 44,553, divide this by 2. Over here, this is going to be 170,706 plus 163,429 divided by 2, or 167,68. Okay, so what I'm now going to go through and do is basically take my net sales, right? So my net sales are 65,357. And over here for Walmart, my net sales were 408,214. I'm dividing this by my average total assets, right? So this over here is going to be giving me 2.44. And this is giving me 1.47. So on this one, I believe the higher the number, the better. And this again is for total asset turnover. Return on shareholders' equity. These companies do not have preferred stock, right? So they can't, because they are publicly traded, they cannot have preferred shares. So when we look over here at return on shareholders' equity and these ratios over here below, we're just going to go ahead and focus on basically what is the average shareholders' equity. Okay, so my average shareholders' equity for target is going to be my beginning, which is going to be 15,347, or my ending 15,347 plus 13,712 divided by 2. So right over here, my average shareholders' equity for target is going to be 15,429.50. Makes sense. It's the number that's kind of in between over here. And then for Walmart, my average shareholders' equity is going to be 71,56 plus 65,682. Going to divide that result by 2. And Carolina is cringing right now. So this is my average shareholders' equity. She's cringing because my Google Sheet skills are just absolutely terrible. Okay, so average shareholder equity. Okay, so now what I'm going to go ahead and do is I'm going to take my net income, right? So I'm going to go ahead and take my net income, and my net income over here is, for target is 2488. I'm dividing this by my average shareholders' equity, and I'm coming up with about 17%. Over here for Walmart, my net income for Walmart is 14,335, dividing that by the average shareholders' equity. And this is giving me at 20%. Okay, let's go to the next one over here. Return on assets, net income. Okay, divided by average total assets. Well, what's good is my net income, we know, is 2488. My average total assets for basically over here for target, we just did that computation above. So over here, this is going to be my return on assets is around 5.61%. Over here for Walmart, my net income is 14,335. My average total assets are 167.88. And so this is about 8%. Okay, debt to assets ratio. This is one of the solvency ratios. So my total liabilities for Walmart, for Target. So my total liabilities are going to be 11,327 plus the long-term debt of 16,859. Okay, I'm going through and dividing this over here by my total assets. This is not average total assets. My total assets over here are 44,533. So my debt to assets ratio for Target is about 65%. For Walmart, my total liabilities are going to be, okay, divided by my total assets of 170 is going to be over here about 58%. Next one over here is going to be times interest earned, right? Which is earnings before interest and taxes divided by interest expense. Okay, so over here, my earnings before interest and taxes, this is going to be the 65,357 minus 45,583 minus 15,101. So my EBIT for Target and then my interest expense for Target is going to be 707. Over here for Walmart, this is going to be 408,214 minus 304,657 minus 79,607. And I'm dividing this over here by my interest expense, which is 2.2 billion. Okay, let's go through and compute these. Okay, so this is going to be, let's see, let's do this manually. So